a typical, that's a typical trade where you want to exit tourism, you want to exit hospitality, you want to give banks a skip and really go back to companies and sectors which would benefit in case there is a medical scare. Manishi Raychaudhuri joins us. Let's take a conversation forward. Manishi, what's the mood like in the region? I mean, are you getting a sense that we could be in for a tough December?
As far as entire Asian markets are concerned, there is a sense of caution, which is quite apparent in the kind of price action that you're seeing on your screen. The most recent trigger is, of course, the new variant of COVID. But having said that, different markets were on a downward trajectory, barring some of the Southeast Asian pockets, for different reasons. In case of India, it was more to do with overvaluation or perceived overvaluation relative to the region, and some of the new recent tech IPOs correcting sharply had kind of added fuel to that fire. In case of North Asia, the concern was regulatory pressures in China and over leverage leading to some contagion across the region. Also, in case of other large markets like Korea and Taiwan, there was a concern that developed market demand growth would take a breather and therefore put pressure on the semiconductor, tech hardware, and memory prices, which had been driving these markets. So basically there were way too many variables that right now investors are forced to play with. And as a consequence, it seems that at least in the near term, this level of volatility would actually continue.
Okay, let's for a minute assume that the news on the virus front is not scary. It gets controlled. It's manageable. Then what happens to a market like India?
As far as India is concerned, I mean, the concern was actually, it commenced even before this new variant of COVID emanated. So that concern hasn't really died down even now. So if you look at India, it started correcting from somewhere around mid-October. And the main reason behind that was a seriously high valuation premium that it was enjoying at that point of time, almost about 90% in terms of price to earnings compared to Asian peers. That valuation gap has declined slightly. It's possibly at around 60% right now, that the last time I checked. But even that is significantly higher than the long-term average, about 30 to 35%. India always trades at a premium because of the relatively higher return on capital and return on equity that the companies generate. But the valuation the premium is perceived to be possibly too high right now. So, I think I think this may continue for some more time, but as a consequence of this 8% correction that we've seen, there's some sectors, some stocks that have corrected a lot more. And so I think some bit of value may be emerging there. It's difficult to say whether investors would perceive that value right now and try to catch that proverbial falling knife. But I think longer term investors may actually be beginning to look at those sectors and stocks that have corrected much more than the market.
Good morning, Manishi. So I'll get to that in just a bit, that where it is that you actually see the valuations correction so much, it has brought about a buying opportunity. But just taking forward the larger question, India's outperformance that has been going on since last year has been like pretty much a straight line rally. We've not even seen those mini corrections. Do you think those days might be behind us? We started to see some voices of caution that have come in.
So, those straight line rallies, as you point out, to borrow your phrase, those are always a bit scary, because after all, we're talking about equity markets, and the volatile narratives on different fronts always lead to a degree of volatility as far as asset prices are concerned. And these volatile narratives have arisen from quite a few sources. If you look at the last 3 to 6 months, there's a concern about the pace of tapering, or for that matter, even interest rate increases at some point of time by the global central banks. Even though the Fed has articulated the exact pace of tapering now, investors are still grappling with the question whether there would be some degree of, over tightening by the central banks at some point of time. COVID is a constant volatile narrative that we have had to deal with over the past 2 years, and it looks like we will have to deal with it over the next 1 year or so as well. In this context, when the news flow is volatile, when the implications of those news flows for the asset markets are, still being grappled with by investors, this straight line rally was, it's something to be concerned about, and especially when it led to the kind of valuation premiums that we saw. So, I think going forward, investors would be a little more, they would pay a little more attention to the valuations of the stocks that they buy. And secondly, I must also point out that it's actually earnings estimate increases that would possibly be very closely watched across sectors. As we have made this point, that it's really earnings estimates and currencies. These are the two strongest variables that influence equity prices, asset prices, and I think those are the two variables that would be keenly watched.
From the sounds of it, when you said India always trades at a premium, the sense I'm getting is that you're still overweight on India. But Manishi, tell me now, taking forward the other point you made, that the recent corrections that we've seen has brought about buying opportunities. What are those buying opportunities?
I would say that there are some in the banking sector. We do think that some of the banks are likely to have some kind of a revival in their loan growth. Maybe not right now, but possibly in the second half of 2022. Even the concerns about asset quality would diminish. It's a combination of several drivers, because much of those loans had actually been to the sectors that were overleveraged, but those overleveraged sectors have actually revived of late. And I'm talking about commodities, metals and mining, industrials, and even property, real estate. So I would think that, the decline in asset quality concerns and an improvement in the sentiment about loan growth driven by both consumption and the likely investment cycle would possibly lead to an outperformance of the banks, and especially that universe becomes interesting after the recent correction. I would also point out that some of the conglomerates, energy or telecom related. Now, telecom is a sector that is that has different drivers, which we have been talking about consolidation in the sector leading to increases in tariffs. But both the pure plays and and the conglomerates in energy, telecom, etc., they possibly have a decent pathway open to them over the medium term. Third, I would also point out the IT sector. I mean, if we are trying to hedge against rupee weakness at some point of time, and when we combine that with the strong news flow about the new orders that have come towards the frontline IT names, then that's one sector that would become, whose attractiveness would become apparent to investors at some point of time. So these are some of the sectors that investors would have to keep their eyes on.
Sure. Manishi, in the near term or the interim period, though, would you stay away from the entire reopen trade? Because on our screen since last week, everything from hotels to multiplexes to a Delta Corp, it's all getting challenged, and most of these stocks are taking a fair amount of beating.
The reopening trade has been volatile and would possibly likely remain so. If across Asia there are some stocks that we have played and we have been playing, but many of them have a very strong domestic leg. So some of the the travel agencies catering to North Asian economies or China, some in Thailand as well. But in case of India, we haven't really played any of those reopening trades. I think these reopening trades, the ones which are entirely dependent on international travel, would continue to be volatile, and it may not be the right time to sort of dip fingers into them. If there are reopening trades available which depend entirely on domestic tourism, domestic travel, and the domestic economy, those might well be fit for some degree of bottom fishing right now. But in case of India, we haven't really ventured into that area.
Sure. Would you also club other globally linked sectors like metals as well in the near term to avoid?
Yeah, metals, we do have a slightly different point of view because we think in the short term, the base metal prices would possibly be weaker than they have been in 2021 over the next 1 or 2 quarters or so, partly because there's a degree of pressure from, let's say, China to curtail the commodity prices in general, and we have seen that in the resource price universe, particularly coal. We have seen it in a smaller way in copper and aluminum. But over the longer term, I mean, if someone is focusing on second half of 2022 or beyond, then we think metal prices could revive. And that's partly because of the global demand boom in the developed markets in particular that we're continuing to see, and because addition of capacity in these sectors take much longer time than the revival of demand. So, it's a bit of a kind of a time horizon play here. I mean, if an investor is short-term focused, he may want to stay away from that universe. But over the next maybe a 1 to 3 year time frame, I think there are stocks within that universe that may make sense, particularly those which are underleveraged.
Your time, and stay safe, and hope to see you soon.